Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dow Inc. Annual Report. Dow Inc. offers a diverse range of businesses and services across various segments. In the packaging and specialty plastics segment, the company provides ethylene, propylene, polyethylene, and aromatics products, as well as other derivatives such as polyolefin elastomers and ethylene vinyl acetate. In addition to packaging solutions, Dow Inc. also offers industrial intermediates and infrastructure products through its Industrial Intermediates and Infrastructure segment. This includes polyurethanes, aromatic isocyanates, chloralkali and vinyl products, construction chemicals, coatings, adhesives, sealants, elastomers, and composites. The company's Performance Materials and Coatings segment provides architectural paints and coatings, industrial coatings, acrylics-based building blocks, silicon metals, siloxanes, and intermediates. Furthermore, Dow Inc. engages in the property and casualty insurance, as well as reinsurance business, expanding its portfolio of services. Dow Inc.'s stock price has experienced a significant decline of over 15% in the past year due to a combination of industry-wide headwinds and company-specific events. The downturn in the chemical industry, marked by higher raw material costs, oversupply, and inconsistent demand, led to an initial decline of approximately 20% in Dow's stock price. The situation was further exacerbated by several key news events. In April 2025, Dow Inc. announced a 50% reduction in its quarterly dividend, which resulted in an additional 20% drop in the stock price. A disappointing second quarter earnings report in 2025, where revenues missed estimates and EBITDA significantly declined due to high energy costs, weak demand, and industry oversupply, further impacted the stock. Fitch Ratings downgraded Dow Inc.'s long-term issuer default rating to BBB from BBB+, citing the company's weak operating performance, high leverage, and negative free cash flow. Several financial analysis firms also downgraded Dow's stock or reduced their price targets due to concerns over the company's outlook, the dividend cut, a weak petrochemical market, and uncertainties regarding market stabilization. In early February 2026, Dow's strategic plan to enhance profitability through AI and automation, while aiming for substantial earnings, involved a reduction of around 45,000 jobs. This news caused a 5.8% dip in shares on a Thursday in early February 2026. The company continues to face pressure on its profit margins due to elevated feedstock costs, energy challenges in Europe, and significant oversupply from competitors, particularly from China. Geopolitical uncertainties have also contributed to supply chain disruptions and economic instability, posing additional risks. Dow Inc. market capitalization of $22 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Dow Inc. holds a significant advantage in their industry. Dow Inc. trades at a higher price-to-book ratio of 1.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 4.65%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for Dow Inc. can be attributed to several key areas. The Consumer Solutions segment has exceeded its carrying value due to projected revenue growth and current market conditions, while the Packaging and Specialty Plastics (P&SB) segment has also seen significant growth. Additionally, the Performance Materials and Coatings (PM&C) segment experienced a 12% increase in revenue, contributing to overall revenue growth. On the other hand, certain segments have driven revenue decline for Dow Inc. The polyurethanes and construction chemicals (P&CC) segment has been impaired due to oversupply in the industry, leading to volume reductions and compressed margins. Furthermore, the industrial intermediates and infrastructure (I&II) segment experienced a 22% decrease in revenue. The company's interest rate contracts have also had an impact on its revenue, with a gain of $17 million recognized in 2025. Conversely, dividends declared and paid by TDCC to Dow Inc. declined from $2,578 million in 2024 to $1,491 million in 2025. These trends highlight the complexities of Dow Inc.'s revenue growth and decline drivers, emphasizing the need for ongoing monitoring and analysis to inform business decisions. The net income of the company experienced significant fluctuations between 2021-2025. In 2021-2022, it decreased by $2.2 billion, followed by an increase of $541 million in 2023-2024. However, this trend was short-lived, as the net income plummeted to a loss of $2.444 billion in 2025. The profit margins also underwent a substantial decline, from 9.5% in 2021-2022 to -12.8% in 2024-2025. The reasons behind these changes are multifaceted and complex. Volatility in feedstock and energy costs had a significant impact on the company's financial performance. Additionally, the shift towards NGLs becoming less advantageous than crude oil-based feedstocks also contributed to the decline in net income and profit margins. The public health crisis and global outbreak of disease, such as the pandemic, further exacerbated the situation. The macroeconomic downturn, market conditions, and announced restructuring actions also played a role in the company's financial struggles. Furthermore, goodwill impairment charges of $690 million and asset impairment charges of $303 million weighed heavily on the company's finances. The equity and earnings losses of non-consolidated affiliates increased to a loss of $240 million, while sundry income expense net decreased from $819 million to $297 million. Finally, interest expense and amortization of debt discount increased by $54 million, further contributing to the decline in net income and profit margins. The company's financial performance indicates a consistent generation of positive operating cash flow over the past few years. According to various pages in the extracted summaries, the company has consistently generated significant amounts of cash from its operations. In 2025, the company reported an operating cash flow of $1,062 million, page 45, $1,032 million, page 75, and $1,045 million, page 80. Similarly, in 2024, the company's operating cash flow was $2,903 million, page 45, $2,914 million, page 75, and $2,939 million, page 80. Even in 2023, the company reported a positive operating cash flow of $5,196 million, page 75, and $5,109 million, page 80. The summaries also highlight that the company's ability to generate positive operating cash flow is not limited to just one source. For instance, on page 114, it is mentioned that proceeds received from new transfers were $538 million in 2025 and $1,533 million in 2024. Overall, these findings suggest that the company has a strong financial foundation, with a consistent ability to generate positive operating cash flow over the past few years. The company's financial performance has undergone significant changes in terms of debt level and interest expenses. One notable change is the increase in long-term debt by $2,138 million from 2024 to 2025, resulting in a total of $17,849 million. This increase is attributed to both new issuances and retirements of debt. The net effect is an overall rise in debt levels. In terms of interest expenses, there has been a notable change as well. Interest expense and amortization of debt discount increased by $54 million, 6.7%, from 2024 to 2025, with the total amount rising to $865 million. This increase indicates that the company is paying more in interest on its debt. The changes in debt levels and interest expenses suggest a shift in the company's financial strategy or market conditions. The increased debt level may indicate a need for additional funding or a change in capital structure. Meanwhile, the rise in interest expenses could be due to various factors, such as higher borrowing costs or changes in the company's credit profile. The financial performance of the company varied across different segments and regions in the recent period. In terms of segments, packaging and specialty plastics and performance materials and coatings were the standout performers, while industrial intermediates and infrastructure, hydrocarbons and energy, polyurethanes and construction chemicals, and industrial solutions struggled. Regionally, the US and Canada, as well as Asia-Pacific, showed strong performance, whereas EMEAI, Europe, Middle East, Africa and India, Latin America, emerging geographic regions, and global regions underperformed. The company also highlighted segments and regions with uncertain performance due to various factors such as ongoing conflicts in the Middle East and Russia-Ukraine, and emerging markets where significant customers or suppliers are located. The performance of packaging and specialty plastics was particularly notable, while industrial intermediates and infrastructure faced challenges across multiple pages. Similarly, EMEAI and Latin America were among the regions that struggled, whereas the US and Canada, as well as Asia-Pacific, demonstrated resilience. The company is committed to transforming its operations through a comprehensive strategy that prioritizes decarbonization, circular economy, and value growth. Key objectives include reducing Scope 3 emissions by developing partnerships along the value chain, processing 3 million metric tons of waste per year by 2030, and driving value growth through next-generation technologies. To achieve these goals, the company is investing in initiatives such as a net-zero carbon dioxide equivalent (COTWE) emissions integrated ethylene and derivatives complex in Alberta, Canada. It is also increasing the use of clean energy and steam in operations, while setting water stewardship goals for 2030, 2035, and 2050. Risk management is a critical component of the company's strategy, with a focus on climate-related scenarios to assess physical and transition risks. The company actively manages market risks through hedging transactions and derivatives, aiming to optimize the US dollar value of net assets and cash flows. Financially, the company aims to maintain a strong balance sheet and financial flexibility by managing net debt as a non-GAAP measure. It has completed debt-neutral liability management activities in 2025, issuing $1 billion and $1.4 billion of senior unsecured notes. Overall, the company's strategy is centered on sustainability, risk management, and financial prudence, positioning it for long-term success. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. The extracted summaries confirm that the company has indeed paid dividends on multiple occasions, with specific mentions in pages 32, 51, and 162. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. According to the summaries, the company has bought back shares, with an approximate total value of $931 million yet to be purchased. This demonstrates a commitment to maximizing shareholder value and providing returns on investment. Concerns about inventory buildup or supply chain disruption are evident in various sections of the report. On page 20, climate-related risks and uncertainties pose a threat to supply chains. Similarly, on page 21, changes in U.S. trade policies and shifts in tariffs create uncertainty for global supply chains. The Russia-Ukraine conflict and sanctions imposed by various countries also contribute to supply chain disruptions, page 22. Furthermore, excess capacity in basic commodities in EMEAI and Asia-Pacific regions puts downward pressure on prices, leading to decreased operating rates. Disruptions to public and private infrastructure and services could impact the company's business operations, page 24. Additionally, a global outbreak of disease or public health crisis can limit access to manufacturing sites due to government-directed quarantines and social distancing measures, page 26. Inventory buildup is also a concern, with inventory levels increasing by $51 million in 2024 and finished goods inventory increasing by $36 million, pages 108. Commodity contracts used for non-hedging purposes may indicate some level of inventory management or supply chain risk, page 150. Overall, these concerns highlight the potential risks to the company's business operations due to inventory buildup and supply chain disruptions. That concludes the financial summary for Dow Inc. Feel free to comment below and I will be happy to answer them when possible.